I published a new blog post yesterday, April 11th, where I discussed some of my stock and bond trades over the past week. As expected, the ceasefire talks with Iran ended in failure. The two sides were just way too far apart on the important points that they had set out before the negotiations had even started on Saturday. I did buy some downside protection last week for my small stock allocation. Trump responded to the breakdown with this statement, quote, effective immediately, the United States Navy, the finest in the world, will begin the process of blockading any and all ships trying to enter or leave the Strait of Hormuz, end quote. If implemented and enforced for several weeks, there is a likely to be a worldwide recession, including one in the United States as a result, in my opinion. Trump believes that blockading ships carrying cargo to Iran and Iran's crude oil shipments will cause them to be more amenable to agreeing to his demands, but I doubt that will be the case. It will make everybody in the world mad at the United States, including all the Persian Gulf countries, China, Asia, Asian countries, European countries, everybody. Recent U.S. economic news and stock valuations continue to keep me mostly on the sideline for stock purchases, and that has been the case for a while now. Over the past 2 weeks or so, I've increased my purchases of short-term investment-grade corporate bonds, mostly maturing next year, which makes the interest rate risk de minimis, using proceeds from maturing Treasury bills, and those would be 3 months to 6 months primarily, which has resulted in lower purchase of T-bills at the weekly auctions. I've gone from purchasing about 40 T-bills each week to 10 or 15, and those are in $1,000 increments. Since I live in Tennessee that does not have a state income tax, I will pay the same tax rate on both corporate and Treasury interest. States with an income tax will tax corporate interest but cannot tax interest paid by direct ownership of U.S. Treasury securities, and that will take away some or all of the corporate yield tax advantage compared to Treasuries, depending on the state tax rate and the spread between the corporate and Treasury securities maturing at about the same time. I will explain what I mean by direct ownership in the more section below. As to the recent economic news that has made me cautious for stock purchases, and I've been reducing my stock allocation this year. The two most important items are the weak job market and inflation. CPI for the 12 months ending in March 2026 rose 3.3%, up from 2.4% for the 12 months ending in February. The month-to-month increase was huge at 0.9%. Most of the increase last month was related to energy commodities like gasoline. The increase was caused directly by the Iran war, the closure of the Strait of Hormuz, and widespread attacks on energy infrastructure facilities in the Persian Gulf region that will disrupt supplies. Qatar, a major supplier of liquefied natural gas, LNG, had a facility hit by Iran that will reduce production by almost 20% for 3 to 5 years, and this country is a major producer of LNG. Then there is a possibility of far more similar attacks occurring in the weeks ahead unless something is done to stop hostilities altogether. The inflationary impacts of substantially higher crude prices on products other than gasoline and jet fuel will take time to flow through into prices. Here I'm talking about increased transportation costs for products, including food, for example, as well as other products using crude in the production process. There are already major supply chain disruptions for factories in Asia and Europe who have had to curtail production or even shut down in some cases due to inadequate supplies of LNG and or crude. As we learned during the pandemic period and its immediate aftermath, supply chain disruptions can cause a major surge in inflation. The supply chain disruptions that are leading to shortages and higher prices involve products other than just crude oil and LNG and extend to products like aluminum and helium. I discussed some of those issues in my most recent blog post. The U.S. government revised down its fourth quarter real GDP estimate to just 0.5%. For 2025, real GDP growth was reported at 2.1%, down from 2.8% in 2024 and 2.5% in 2023. In an estimate made on 4/9/2026, the Atlanta Fed estimated that the real GDP growth for the first quarter was just 1.3%. I suspect that will be too high when the government tallies the final number. And if the Strait of Hormuz remains closed for much of the second quarter, I expect a negative real GDP number for the second quarter. The Atlanta Fed GDP estimates can be found at its website. It's called GDP Now. While there was a pickup in job growth in March, the total number of new jobs created in 2025 was only 181,000 according to the BLS and an average of only 68,000 for the first 3 months of 2026. By any measure, this is an extremely weak jobs market. In the March employment report, annual wage growth slowed to the lowest increase since May of 2021 during the pandemic period. The University of Michigan reported its consumer sentiment number last week. Consumer sentiment fell to the lowest reading ever, falling to 47.5 from 53.3 last month. So all of this sort of confirms my approach that I've taken for several weeks, even months now, that leads me to be extremely cautious in my allocations and continuing to emphasize treasury bills and short-term corporate bonds over stocks, and I also have a significant cash reserve in treasury money market funds. About over 50% of my Vanguard account is in their low expense ratio treasury money market fund. So we'll see how the stock market reacts on Monday. I'm expecting a major down day.